Welcome. In today's video, I'm analyzing Reliance Industries. Again, it's the same format. I'll be analyzing the P&L account in detail, then the balance sheet and the cash flow statement, and finally the quarterly profit and loss account. So the format is the same as the last video of L&T, Larsen and Toubro. So maybe I'll skip some of the parts and not explain everything in detail again. So if you would want each ratio to be understood in detail, you can watch my last video of Larsen and Toubro to understand how I analyze each company in detail. This is very important to analyze the company in detail instead of just going over a few ratios. Although understanding core ratio is also important, but generally we should look at all the ratios in detail and understand how the company is functioning overall, and try to find out these red flags that I keep talking about in every video. So let's begin our analysis. As usual, we'll begin with the sales growth rate, CAGR percentage of the last 5 years, 3 years, and the latest 2019 to the recent 12 trailing months. So in the recent 12 months compared to the March 19, there was a growth of around 5.5% in sales. That is, sales increased from 5,66,000 CR to 5,97,000 CR. In 3 years, last 3 years, the growth rate was very high at 27.6%. In March 16, although the sales had dropped to 2,72,000 from where it was in March 14 at 4,33,000, we can see a drop in the sales. But from there, in the recent 3 years, it has picked up to 5,66,263 crores. Whereas if you compare it in the last 5 years, we see a growth rate of 5.4%. Moving on to the next chart, average operating profit margin of the last 5 years stood at around 14.3, whereas in the last 3 years, it stood at around 15.4%. So this is the average of the last 3 years. Let us look at the 19 OPM margin. It was 14.8%. On a total sales of 5,66,000 CR, the company's operating expenses were 4,82,000 crores. And in the recent 12 months or the latest 12 months, the margin is still at around 14.5%. So what we can see is that the company's range is slightly above 14% and below 16% throughout the last 5 and 3 years. Next, let us look at how much other income is contributing to the total net profit. So one of the source of income is through sales, where revenue is generated, and other is through other income. Average, we can see that since 16 till the recent 12 trailing months, it has never exceeded 5% of other income percentage. This is a calculation compared against the sales. So we don't want a very high percentage of revenue being generated through other income. So most of the income should be coming through sales. In terms of depreciation, how much depreciation is being charged to the P&L account every year. So in March 16, the depreciation rate was 4.2%. This is not the depreciation rate but actual percentage of the total sales. So on a it was in March 16, it was 11,000 crores of depreciation. This is the value by which the asset was depreciated in March 16. And in the recent 12 months, 21,000 crores of depreciation was charged to the P&L account. The total sales at that time was 5,97,000 crores in the recent 12 months. So we can see again a very quite stable depreciation being charged to the P&L account against the sales of those years. The raw material cost has been somewhere around 83% in March 14, which has dropped to 68% in March 16, and in March 19 it was somewhere around 70%. So the raw material cost as a percentage of total sales has reduced a little bit. Employee cost is very low at somewhere below 3% over the years. So these ratios help us understand how what are the red flags or potential red flags or potential problems that we can detect. So these ratios would help us do that. Let us look at the interest expense as a percentage of total sales. So out of the revenue generated through sales, how much was the interest expense? In March 16, total interest cost was around 3,600 crores, which has ballooned in the last 4 years to 20,000 crores. But when we look at when we compare this interest cost against the revenue being generated, it is still at a very stable rate of 3.5% of the total sales. Even in March 19, it was 16,000 crores, but in percentage wise it was just 2.9%. And in March 16, it was 3,600 crores, but percentage wise it was just 1.4%. So this is also good. We see that company is generating more and more sales, although it is paying more and more interest cost, but the sales are also increasing. In terms of tax rate that is being paid, it is somewhere below 30% throughout the years. Now, what is the interest coverage that the company is managing over the years? In March 16, the coverage was quite high at 11.5 times. That is the EBIT, or earnings before interest and tax, being generated was around 42,000 crores, against which its interest cost was 3,600 crores. So that's a 11 times multiple. In March 19, the interest cost increased, as we saw in the previous chart, whereas the EBIT being generated was around 71,000 crores. So that's just a 4.3 times multiple. But in the recent 12 months, the multiple has dropped below 4 times. My benchmark is that the finance cost should be 1/4 of the EBIT being generated, or we can also say that the EBIT that the company generates should be more than 4 times of the interest cost or the finance cost. Net profit margin of March 16 was 10.9%, which decreased to 7% in March 19. Although the overall sales increased, the profit has not increased at that pace. In the recent 12 months, the margin is still intact at around 7.3%. Again, the sales has increased, but the profit has marginally increased. So we would want to see at least 10% of NPM, or we can look for a fixed growth in net profit margin or a stability in net profit margin. The average net profit margin over 5 years was 8.7%. 3 years again it was similar, 8.7%, and in the recent 12 months the margin has dropped to 7.3%. So recently it is below its averages. Let us look at how the profits have grown over the periods. In the last 5 years, the profits from 14 to 19 has grown at the rate of 12% compounded growth rate. In the recent 3 years, the growth rate has slowed down to around 10%. That is from 29,000 crores to 39,000 crores from 16 to 19. In the recent 12 months, the margin or the net profit growth rate was around 9.5%. So from March 19 to the recent 12 months, that is from 39,500 crores to 43,000 crores. Let us look at the valuation ratio price to sales. This is the comparison of where the market cap is against the sales of those years. In 16, the multiple was 1.7 times. Sales was 2,72,000 crores, and the company's value in the market was 4,63,000 crores. So we buy when the numbers are near to each other, that is near to 1. In March 19, the multiple fell to 1.4. The sales increased and the market cap also increased. So we want to see both of them increasing, the sales as well as the market cap. In the recent 12 months, the multiple has further dropped to 1.1. The good thing happening here is that the overall market cap of the company has fallen. that is the price of the company per share also has fallen, whereas the company at the same time has managed to generate higher sales. Therefore, the multiple is very nearby to each other. So this is the appropriate time to buy into the company. In terms of how much dividend was being paid out of the net profit, in 14 the payout rate was around 12%, whereas in March 19, 9.7% of the profit was paid out as dividend. When we look at the numbers as such, they are very nearby to each other. Every year we can see the profit increasing, but the dividend payout rate or dividend as numerical values has not shot up at a very high rate. Next, we'll look at the price to earnings ratio. This is the price per share divided by the earnings per share. In 16, the multiple was somewhere around 15.6 times. That is, the earnings per share was 33.5 times, and we were paying a multiple of 15.6 times to buy each share at 523 rupees. We want to buy when the multiple is below 25 times. That is, we should not pay more than 25 times the earnings or the profit being earned against each share. In the recent 12 months, the multiple is somewhere around 16.2 times. This is the latest price earning multiple. Against the earnings per share of 68 rupees, the company's price per share was around 1105 rupees. This is the latest price of the company per share. So we are getting at a good price earning multiple. Let us look at the average price earning where it was trading at. In the last 5 years, the multiple was quoting at around 18.6 times, and in the recent 3 years it had increased to 20.6 times, whereas the latest price earning multiple is below its averages of both 5 and 3 years. Let's move on to the balance sheet analysis. If I missed out any of these ratios, I'll cover it later in the separate ratio analysis. Equity share capital over March 14 to 16 was flat at 2,900 crores, whereas in March 19 it has almost doubled to 5,926 crores. So the company must have issued additional either bonus shares, or in some way the capital has increased because of those issues. Return on equity ROE should be above 15%, but we see from 14 till 19 it was quite flat at less than 13%. So here what we are trying to do is understanding how much company has earned as net profit against the shareholders' money or contribution of the shareholders in the company. In March 19, 3,87,000 was from the shareholders' contribution towards the source of funding to the business, whereas the net profit earned was around 39,000 crores. So that's a 10.2% of net profit being generated on shareholders' money. We want to see at least 15% of ROE. Let us look at the 5 years average. On an approximate basis, it was somewhere around 11.5%, and throughout the averages of 7, 5 and 3 years, we see it being somewhere around 11% itself. So in March 19, the ROE fell below its averages. Return on capital employed uses the capital employed divided by EBIT. We are trying to understand out of the total sources of fund the company has employed into the business, that is through shareholders and through borrowings, how much EBIT it is generating every year. In March 19, the company had generated a 10.3% of ROCE. We would want to see here too 15% of return on the total capital being employed into the business. So the total sources of fund the company had through borrowings as well as through shareholders or owners of the business was 6,94,000 crores. So this was the total capital employed into the business. On that, the company's top line profit was 71,000 crores. So that's a 10.3%. As I mentioned earlier, we want it to be as high as possible. In 16 and 14, the margin on, that is the return being generated, was quite low at 6.9%. On an average basis, if we see, the 7, 5 and 3 years were all below 8%. So in March 19, the 10.3% that the company generated was above its average. So even if the company is not generating a 15% of ROCE, that does not mean that it's a bad company. It's just that we have to see where overall the company's ROCE has been throughout the years. If it is constantly generating returns on those percentages, then we have to take that as a benchmark to analyze how the company is doing. We don't want a wild fluctuation in ROCE, but at the same time we don't want a very low return on capital employed. In this third chart, we'll look at return on assets, ROA. We'll compare how much net profit the company generated on the total assets of the company. This is the balance sheet size of the company. In March 19, the total balance sheet of the company, that is all assets considered together, was around 10,23,000 crores. This is the total assets of the company. On that, it generated around 39,000 crores of net profit. That's a 3.9% multiple. Here we don't have a benchmark as such, but we want it to be as high as possible. So if we look at March 14 and 16, we see in March 14 it had done pretty good at 5.2%, which has been dropping to 4.9% and then to 3.9%. Let's move on to the right hand side, debt to equity ratio. This is the total debt divided by equity. We want to understand how much debt the company has or how much borrowings it has done against how much funding it has received through shareholders, that is equity plus reserves or any retained earnings. So we want this multiple to be below 1 times at least, and throughout 14, 16 and 19 we see a multiple which was below 1 times. So its equity was always higher than the debt over the years. In March 19, the company's source of fundings were divided in debt and equity. Debt contributed around 3,07,000 crores and equity contributed around 3,87,000 crores to the business. We don't want the debt portion to be very high, as that would mean that the company would have to pay more and more interest cost and its finance cost burden would increase. Next, let us look at what is the equity percentage of the total assets and debt percentage of the total assets. In March 19, 38% of the total source of funding was from the equity holders or the owners of the company, and the debt contributed around 3,07,000 crores, which we already saw. And if we look at the numbers over the years, it has always been below 50% for equity and around 32%, below 32% for debt. So this is the numbers that it has managed over the years. I have deliberately not included 15, 17 and 18 to keep the chart at bare minimum to understand how the trend has been over the years. So we don't need to look at every year, but over the years from 5 years back and from 3 years back, how the company has managed its equity and debt portion. That, even if we know, that is good enough. If we wanted more detailed understanding, then we can always look at the balance sheet separately. Next valuation ratio is price to book. We're trying to understand how far away the price of the company is compared to its actual net worth or its actual value. So we are comparing actual value against the market value. So we don't want the price to book ratio to be very high. In fact, we should try and buy it as low as possible, below 2.5 times. In the recent 12 months, or the latest price to book ratio was at 1.7, below my benchmark. So the company's actual value was 3,87,000, whereas in the market it was trading at 6,54,000 crores. So a good multiple As we saw earlier, price to earnings was also good. March 19 it was 2.1 and in March 16 it was 2. So it has always been quoting at below 2.5, at least whatever data we have on the screen. The current ratio compares the current assets against the current liability. This is the liquidity ratio. We are trying to understand here is how much liability it has to pay in this current year, against that how much assets it has. We want the ratio to be, or the multiple to be, above 1. In March 19 the multiple has fallen below 1 times, which is not a very good sign. The total liability it has to pay in this year is around 3,28,000 crores. That is in March 19, against which its total assets or current assets, the assets it can sell within this year and pay this liabilities which will arise in March 19, were not enough. So it always creates a working capital pressure, or the company has to borrow more and more funds to support paying these liabilities. But if we look in March 16 also, the company's current liabilities were more than its current assets. In 14 the position was opposite, it had more assets than it had liabilities. So we don't want this position to be consistently being there, as this creates, as I mentioned earlier, working capital problems for the company. Let us understand what is the total assets it has on its books against, that is, what component of the total assets is the net fixed assets. We don't want a very high net fixed asset percentage. In March 19 the total assets of the company were around 3,98,000 crores out of the total balance sheet size of 10,23,000 crores. So that's a 38.9% multiple, 38.9% of fixed assets against the total assets of the company. But even if you look at 14 and 16 values, it was always around these numbers. So my benchmark or cutoff is above, should be less than 30%. But when we look at the overall trend throughout the years, the company's assets always occupied, that is fixed assets always occupied a big chunk of the total assets, that is total balance sheet size. How much assets were still under progress, still being built up, that is capital expenditure. We see in 16 the company's total current capital work in progress, that is those assets on which the work was going on and which would be added to the net block or net assets in the future years. In March 16 it was quite high at 38%, meaning 2,28,000 crores of assets were being built up, and these were not even ready, and this will be transferred to the balance sheet as net block or gross block, and on that the depreciation will be deducted. So it is quite high at 38% in March 16. Maybe the company was developing its or doing capital expenditure, because of which its total capital work in progress ballooned up to 2,28,000 crores against the total assets of 6,01,000 crores. That's a 38%. In March 19 the expenditure on capital work in progress was around 1,79,000, whereas the total assets increased to 10,23,000 crores. So we see here the company has now again reduced its capital work in progress as a percentage of total assets at below 20%. Here too my cutoff is around 30% approximately. That is, we don't want too much capex going on into the business as a percentage of total assets. Next let us look at the investment percentage, that is how much investments were there in the company against the total assets. So we are looking at the components of the total assets, that is investment, debtors, capital work in progress, net fixed assets, and so on, and trying to understand which components are occupying how much percentage of the total assets. In March 19 the total investments increased to 2,35,000 crores. These are the investments through which the company earns other source of income other than the revenue generated through operating activity. So here too we don't want a very high investment. If the company has a lot of cash, temporary cash or excess cash with it lying idle, it can always invest and generate other income, but this should not be there a constant feature. That is, you don't want a very high investment activity going on into the business. So out of the 10,23,000 crores of total assets, the company's investments was 2,35,000 crores. That's a 23%, which is quite high according to me. But as and when the company would require this fund or to invest in capital expenditure or to pay dividend, it can always reduce this amount back again. Till that time it can have a high investment. If we go for March 16 and 14 figures, we see it was around 14% on an average. So this was a good value at that time, but now that has increased to 23%. It's not a bad sign, it's just that the company has a lot of excess investment which it can always transfer, as I mentioned earlier, to pay off dividend or even do capital expenditures in the forthcoming years. The debtors as a percentage of total assets, this is the total money to be received from the customers. In March 19, the company had to receive around 30,000 crores from its customers. This was still pending to be collected, but it is just 2.9%, which is very low when compared to the total assets of the company. Even in March 14 and 16, it was quite low as a percentage of the total assets. So this is the good numbers. Next, let us look at where the sales was compared to the debtors. This is the multiple of sales and debtors. In March 14, the company did a sales of 4,33,000 crores, against which its collection of that year from customers was just 9,400 crores. That's just 2%. And throughout, it has managed to keep it at a very low percentage number. In March 19, total sales done was like 5,66,000 crores, against which only 30,000 crores was pending to be collected as of March 19. That's just a 5%. Here we don't want the company's debtors or customers to exceed 30% of collection against the sales of that year. So these are all very good numbers. How fast the company is collecting payment from its customers that we saw in the earlier chart. In this chart, we are trying to understand how quickly it is collecting payment from its customers. So we see its collection is very efficient. In March 19, the number of days it was giving to its customers to pay back was around 19. In 16, it was quite low at 6, and in 14, it was just 8 days. So although the company has increased its debtor days or collection days from its customers, it is still very reasonable. I would even want to buy into companies where the days don't exceed 90. So different industries would have different collection days. Next, we are trying to understand how much was the inventory as a percentage of total assets. So we don't want a very high inventory holding into the business until and unless there is a order pending into the business which it has to fulfill. In 19, the overall inventory percentage was just 6.6. Whereas if you look at 14 and 16 values, it was very decent at around 13 and 7.7%. We don't want a very high inventory holding, as I mentioned earlier. Against the total assets of 10,23,000 crores, the company's inventory holding, that is the amount of inventory or the raw material that was still under progress of manufacturing, was 67,000 crores. So we do, as I again mentioned, we don't want to hold a very high inventory, which will mean that the company's money is stuck in these inventories. In terms of inventory turnover, that is sales compared with the inventory, we want it to be as high as possible. So the company's inventory holding of March 19 was 67,000 crores, against which it did a sales of 5,66,000 crores. That's a 8.4 times multiple, meaning whatever inventory it was holding, it managed to multiply it by 8.4 times to convert it into sales. In 14 and 16 also we see a very similar figure, but lesser than what it was in March 19. So we want the multiple to be as high as possible. Understanding all of these ratios is very important. Next, let us understand the cash flow analysis. Moving on to the net profit to the cash flow from operating activity comparison. Here we are trying to understand, this is a very important ratio. We are trying to understand out of the net profit declared by the company, how much has actually been received by way of cash in the operating activity itself. So we have three activities: operating activity, investment activity, and financing activity, all related with cash inflows and outflows. In March 14, the company's total net profit was 22,000 CR, against which it showed a cash from operating activity of 43,000 crores. So that's almost 92% more than its profit. So this is a good value. We want as much cash high as possible against the net profit of the company. In 16, the cash coming in was more than the net profit by 28%, and in 19, the cash generated was around 16% more than the profit declared. So we want the cash coming in through operating activity to be as high as possible. Now let us compare the averages, where over the years, last 7 years, the total net profit the company earned was 2,69,000 crores. This is the 7 years total net profit, against which the cash generated in these 7 years total in total was around 3,19,000 crores. So that's a 58% more cash coming in against the net profit. In 5 years also we see the same figure of 51%, and in 3 years also around 50% more cash was generated than the profit declared. So both these charts are very important to thoroughly understand, as this helps us understand whether the profit declared is genuine, or against that if cash is actually coming in or not. Next, in this chart we are trying to understand, out of this cash that the company received through operating activity, how much was actually invested in the investing part. Here in March 14, the total cash flows from operating activity was 43,000 crores. So this is the cash it received through operations. Out of that, 73,000 crores. So not only has it invested 43,000 crores, over and above this, it invested more, totaling to 73,000 crores in buying of fixed assets. So that's a 169% more cash going out of the operations than what was earned in March 14. We don't want to see a value like this. What basically we want to see is that whatever cash the company is earning through operating activity, 50% or slightly more can be invested in buying of fixed assets. But in 14, 73,000 crores was invested. Maybe the company had capital expenditure in those years. In 16, 95% of the cash earned was invested in buying assets, whereas in 19, the company's investments in buying of assets or fixed assets was 215% more than what it earned as cash in 2019. So the investment in assets has always been very high when compared to the cash it is earning. So the company is very capital intensive. So this is shown through this chart. When we look at the averages of these 7 years, 5 years and 3 years, we see that in last 7 years the total cash earned was 3,19,000 crores. Against that, the company invested 4,34,000 crores into its business of buying assets. It's a very high value. In last 5 years, the total assets stood at around 3,31,000 crores. That is investment in fixed assets, against the cash earned of 2,39,000 crores. So we see that over the years the company's percentages have always remained stable at around 130 or 140%. So whatever cash it is earning, more than that it is investing in buying of assets. So we don't want to see a figure like this, because we want a gradual increase in the growth of the company. If the company is investing more than what it is earning through operating activity, then that means that the company is borrowing funds from external sources to invest in its business. Next, let us look at the quarterly analysis. The sales has declined YOY by 2.5% from December 18 to December 19, and quarter on quarter it has increased by 2.4%. So from 1,49,000 crores in September 19 quarter, it has increased its sales to 1,52,000 crores in December 19. So YOY it has fallen by 2.5, and quarter on quarter it has increased by 2.4. Profit growth YOY was 13.5% from December 18 to December 19, whereas on a quarter on quarter basis the growth was around 3.4%, from 11,000 crores to 11,640 crores. So understanding the quarterly analysis is also important to see where the company or how the company is progressing through these quarters. Net profit margin on a quarterly basis was less than 8%. In December 18 it was 6.5, and even in December 19 it was somewhere around 7.6, where it was even in September 19 at 7.5%. So on an overall basis the margin for the company is quite low, because it trades in volume rather than in value. So this completes my analysis of Reliance Industries on a graphical basis. Next, let us move on to analyzing the core ratios. In this part of the chart, we are understanding the core ratios of the company. Current market price of Reliance is around 1,105 rupees per share, and the results are up to date till December 2019. The sales on a quarter on quarter basis, as we saw, that is YOY, has decreased by 2.52%, whereas the quarterly profit has grown by 14.92%. So the sales has fallen YOY, but the profit has gone up by 14.9%. The sales on the 12 trailing months when compared to 2019 has increased by around 30,000 crores, from 5,66,000 crores to 5,97,000 crores. So this is the value of sales in the recent 12 months when compared to the 2019 sales figure. When we compare the profits have also increased in the recent 12 months to 43,000 crores from 39,000 crores in March 2019. The cash coming in 2019, that is cash from operations in 2019, was around 45,000 crores more than the profit declared of 39,000 crores in 2019. So we have a good value here where we see more cash coming in against the profit declared. The price has fallen around 31% from its 52 weeks highest point. The 5 years price earning average was around 12, whereas 3 years price earning average was around 13, and the current price earning is 16. So we are getting it slightly above its 5 and 3 years average. When we look at the price to cash, it is somewhere around 15.3. Here too we want to buy below 25 times for price earning and price cash. Price book is around 1.7, which is below buying benchmark, which is again a good value. The PGs are good because the price earning multiple we are paying of 16.1 times. For that we are getting a profit growth rate of 13.9% over a period of 5 years, and since last 3 years we are getting a profit growth rate of 10.2%. So we are getting a good profit growth rate or earnings growth rate against the price earning multiple that we are paying. Sales is also growing over the last 5 years at the rate of 5.4%, and in the recent 3 years the sales has picked up to 27%. As we saw in the graphical chart, where when we analyze the sales growth, we saw that the sales had fallen from March 14 to March 16, and from March 16 to March 19 it had picked up. So this is what is indicating in terms of 3 years growth rate. Return on equity is slightly below its 5 and 3 years average of 12%. ROCE is very nearby to its average of around 10 to 11%. Return on assets is very nearby to its 5 years average. This is the recent 12 months return on assets value. The amount of sales done against the assets is very nearby at 0.81 times. That is, the sales was slightly less than the assets employed into the business. The sales were around 8.82 times against the inventory in 2019, whereas 3 years back it was somewhere around 6.3 times. The sales were higher by around 6.3 times the inventory holding 3 years back. The profit over the last 5 years was around 1,57,000 crores, and the cash generated was 2,39,000 crores. So here we have a good value where the company is generating more cash than the profit declared. But when we go to the free cash flow, we see a negative free cash flow, which means that the company is deploying more cash than what it is earning in buying of assets. So this company is very capital intensive, meaning it requires a lot of money to be invested in fixed assets. So this is what is indicating in terms of free cash flow. It doesn't have any cash flows to pay as dividend or doing buyback or bonus, because most of it is deploying back into the business in buying assets. The average profit of the last 5 years is at around 31,000 crores every year. The market cap of the company is at around 7 lakh crores as of today, against which its net worth stood at around 4 lakh crores. So the company is trading at a good price to book value multiple, not a very high price to book multiple. Contingent liability stood at around 27,000 crores against the net worth of 4,05,000 crores. So this contingent liability too is within a very reasonable range. Debt to equity is 0.62 times, which is a good value. We don't want it to exceed 1 times. Coverage, although, is slightly lower than the 4 times multiple which I've set as my benchmark. Promoters are holding around 48% of shares in the company, and none of the promoters' shares are pledged. The debtors to sales percentage, which we already saw in the graphical chart, was around 3.5% of the total sales, meaning debtors were around 3.5% of the total sales of 2019. The collection from debtors was also very quick at around 19 days. The net profit margin of 2019 stood at around 6.9%, which is low, but when we look at the cash being generated by the company, this is okay. The company was paying a dividend yield of 0.59% at current market price. So this concludes my analysis of Reliance Industries. This company also I would buy gradually as it goes down, because this is also a good company. It is managing its numbers, quantitative numbers, very well. Thank you for watching this video.